Every year, millions of people start a business looking for personal freedom, but instead of buying their time back, they end up buying themselves a stressful 60-hour-a-week job where they're stuck working the counter from morning to night. Look at the standard playbook. An entrepreneur wants a setup that gets noticed, so they pour capital into custom neon signs, retro diner stools, and an Instagram-ready aesthetic. Opening day brings a huge crowd and viral reels, but underneath the glamour, it requires constant daily hustle just to keep the lights on. Meanwhile, some of the most financially secure entrepreneurs out there are running operations that are practically invisible to the general public. They are operating commercial cleaning companies, renting out heavy construction equipment, or dispatching pest control teams to warehouses. When you prioritize social prestige and creative expression over a fundamental market necessity, you lock yourself into a cycle of constant customer acquisition. You build a job, not an asset. The modern self-serve laundromat is a masterclass in this exact philosophy. It is an entirely unglamorous operation built strictly on recurring human necessity. This chart shows the survival rate for standard small businesses. By year 5, half of them have completely shut down. Now look at the second bar we're adding for laundromat startups. That survival rate stays remarkably high, at 95% over the same 5-year period. These necessity-based models also generate an expected return on investment of 20 to 35% in their first year. Because people need clean clothes regardless of the broader economy, the revenue stays stable even during a recession. But safety and high returns carry a steep price of admission. To capture those margins, you have to navigate severe upfront operational complexities and heavy capital costs. Traditional retail models share a fatal flaw. Every single morning, the revenue resets to zero. The owner is forced into a relentless daily hunt to convince new customers to walk through the door. This diagram illustrates the alternative mechanism. By securing recurring revenue, a single upfront effort yields continuous, automated payouts month after month. Think about outsourcing hotel laundry or providing daily cleaning services for a commercial office. You negotiate the deal once, and customer acquisition becomes a single event rather than a daily struggle. The operational trade-off is intense. Landing these corporate deals requires an aggressive initial sales push, and keeping them requires flawless, ongoing compliance with unforgiving service-level agreements. Escaping the daily retail hustle means trading the casual foot traffic of everyday consumers for the rigorous, high-stakes demands of corporate contracts. For retail-based automated operations, like self-serve laundromats and vending machines, physical placement completely dictates your total revenue. The iron rule for these models is strict. You must select commercial locations based entirely on hard data. You have to completely ignore how convenient the commute is for you personally. This map highlights exactly what you're looking for. You need a high density of renters, specific household income brackets, and close proximity to local anchor points, like college campuses or major transit hubs. The major trade-off here is that the mathematical ideal location is rarely in your backyard. It might place your business in a transitioning neighborhood completely across the city. In infrastructure-based businesses, a massive marketing budget cannot fix a bad location. The geographic placement itself is your primary product. The largest hidden barrier to entry for these businesses is the massive upfront capital required to purchase true commercial-grade physical infrastructure. Buying cheap consumer-grade equipment is a false economy. To succeed, you have to invest heavily in high-spin, high-efficiency commercial machines that can handle relentless daily use. This line graph maps out the long-term mathematical advantage. A high upfront investment drastically lowers your ongoing utility bills for water and energy, while accelerating how fast customers cycle through the store. Navigating this steep initial cost usually forces operators to secure complex commercial financing long before they ever unlock their doors. It runs on the strict logic of asset rental. Whether it is a row of washing machines or a fleet of heavy tractors, the hardware eventually recovers its own cost, turning all subsequent bookings into nearly pure profit. This frighteningly high capital requirement acts as a protective moat. It keeps casual competitors out of the market and secures long-term dominance for serious operators. The idea of effortless passive management is a myth. Removing yourself from the daily operations requires rigorous integration of software as a service. Modern software dashboards allow you to remotely track which machines are most popular, schedule pinpoint maintenance, and implement dynamic pricing from anywhere in the world. Revenue collection has also shifted. Operators are actively moving away from high-maintenance physical coin drops and integrating mobile payment apps and direct card readers. This chart shows the cash flow advantage of this technology. Digital systems completely bypass the typical 30-day wait of a traditional invoice, depositing capital into your account instantly. There are concrete trade-offs to this digital integration. You take on recurring credit card processing fees, you must maintain basic software literacy, and you risk alienating customer segments that rely strictly on cash. True passive income is never an accident. It is the deliberate result of aggressively building, financing, and monitoring a highly leveraged technological system. Before you pursue this path, you have to decide if your personal resources and psychological makeup actually align with the demands of the work. This radar chart outlines the system builder's profile, measuring readiness across capital access, tech literacy, and ego detachment. The ideal candidate demands statistical safety over excitement, completely comfortable managing operations through a digital dashboard. If you are an entrepreneur seeking a personal brand, creative validation, or viral social media fame, you must avoid this model entirely. This is a direct trade-off between ego and equity. To achieve genuine financial freedom in this sector, you have to be willing to build something that the public will actively ignore. The primary difference between wealthy entrepreneurs and struggling ones is where they focus their effort. Wealthy operators build systems to capture repeat cash flow, rather than chasing passing cultural trends. There is immense financial power in solving boring, everyday infrastructure problems, like laundry, safe drinking water, or pest control, consistently and reliably. When evaluating your next business idea, ask yourself one simple question. Will this model require me to hunt for one-time payments every single day, or will it pay me automatically and repeatedly? In the business world, the most reliable and lucrative paths to lasting freedom are always found exactly where the applause is the quietest.